Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's blog was titled Wisdom of a Master in Applying It to Modern Times. And the master that I was studying, when I first got in this business, I decided that anything I could learn from the best investors that ever lived would obviously help me a great deal in my career. And certainly one of those masters is the Venerable T. Rowe Price. And in the book Money Masters by John Chain, Mr. Price talked about several things that he uses on how to buy a stock or how to value a stock based on valuation. I'm going to just cover 5 of the first 7 because I think they very specifically apply today. And if you as you recall in the blog, the first was a record of earnings growth. In the case of ITT Educational, here's a company that has really terrific earnings growth. As you can see, earnings have grown by 28.5% a year over the past 15 years. But then he also pointed out that don't forecast that too much into the future. So even though ITT had a 28.5% growth in the past, if you look at it from a forecasting point of view, the forecast is for 15% growth going forward. So this company does have a great record, but at 15 times earnings, it would be an attractive long-term buy today, assuming that the 15% earnings growth is accurate. And point number 2, Mr. Price said the best time to buy stocks is when growth stock. And the best time to buy growth stocks is when they're out of fashion. And here's an example of Fiserv. And as you can see, the best time to buy Fiserv on this chart was either when it was certainly in value, but the best time was when it was out of value or out of fashion or out of favor here, because you could have bought it somewhere down here at very, very low attractive valuations and saw a very short, very quick rate of return. The second example of number 2 would be Aflac. As you can see, Aflac has always traded at a premium or in line with its earnings growth, and then you had this period here where the price fell dramatically, and of course, it got all the way down to $10.83, as you can see, the low in 2009, and the stock was clearly out of favor. What a terrific time to be buying a company like Aflac, and so, buying a good company when it's out of favor means you're buying it on sale, and that simply makes sense. In point 3, Mr. Price talked about blue chips with a record of rising dividends are worth a higher multiple than secondary stocks that don't have dividend growth. So if you look at a name like Pepsi, you can see the market has historically priced Pepsi at around a 23 multiple. By the way, today you can buy it at 15.6 times earnings. It has a 2.8% dividend yield. But if you look at the long-term record of PepsiCo, you can see that clearly since calendar year 1990, they've literally raised their dividend every year. So that based on your original purchase, you were getting a raise in pay, and your dividend increased from $1,692 on a $100,000 investment in your first year to over $8,000 in 2007, $12,000 in 2008, and so on and so forth. The bottom line is that a blue chip with a record of rising dividends has a premium, is worth a premium, because this dividend income obviously adds additional value than by looking at just a company that is a pure growth stock. In point 4, Mr. Price talked about the fact that stable growth stocks are worth more than cyclical stocks. And so if you look at a company like U.S. Steel over the last 20 years, you can see that the prices have a great deal of cyclicality, and it's been very, very difficult to make any money in this stock because you really never know what the earnings are going to be like or what the performance of the company is going to be. So, buying a stable growth stock like, Aflac or Fiserv that we showed previously, made a lot more sense to Mr. Price. And then the final point I'm covering today is Mr. Price said that one should pay a lower multiple of earnings for growth stocks when bonds are available at high yields. This is an interest rate scale here going back to 1991, and I want you to notice that the yields are actually very, very low. So technically speaking, you should be willing to pay a higher price earnings multiple, as Mr. Price said, when bond yields are very, very low. When bonds are high, then they're more competitive with stocks. So, and the advantage, the point I'm trying to make is right now, if you look at stocks today, even like the ones, that I've already shown you, companies like Procter & Gamble are trading at some of the lowest price earnings ratios, indicating a very strong bargain. Learning from the masters is really, I think, a very smart thing to do as a long-term investor. T. Rowe Price is certainly one of the best that's ever lived. This is Chuck Carnevale saying thanks for listening, and I'll talk to you again.